It's a very good time to welcome Prashant Khemka, founder of WhiteOak Capital Group. Thank you so much, Mr. Khemka, for joining us. Well, just as we were celebrating a trade deal with the United States, we are now grappling with geopolitical tensions at the current market junction. How are you looking at equities as an asset class? And are you also worried about what this particular war could lead as far as commodity prices are concerned as well?
Thank you, Vivek. Certainly, any war, particularly a war of this magnitude, would be worrying to anyone, including as an individual or as a human, and certainly as a market participant as well. But stepping back, if you see over the last many decades, the first war that I remember of size would be in the early 90s, right? Where the Kuwait related, Iraq's invasion of Kuwait and the war that ensued following that. And there have been multiple wars since then. Now, so far, these wars have been contained, both in their scale, certainly in their scale, though obviously Russia, Ukraine, you've seen, has dragged on for much longer. So let's say we don't know, we are not war experts, we don't know how long this would last, whether it intensifies, whether it resolves itself very quickly, but the future of the market would be a function in the near term of these outcomes. So if the war were to resolve soon, right, whenever you're in the midst of it, it never seems like it would resolve soon. But if it were to resolve soon, then we'll see market bounce back. If it were to go into a tailspin and get out of control beyond what the level of intensity is right now, then there could be further impact on the market. The market has pulled back about 4%. Indian market I'm talking about. Globally, markets have been to varying degrees. Obviously, South Korea is down 20%, but it's not just related to war. It's just a function of also what it had done, over the last 15 months or so. So it can also end up being a long-drawn affair, like Russia-Ukraine. Now we no longer talk about Russia-Ukraine war. Nobody talks about Russia-Ukraine war anymore. Yeah? So if it does turn out to be a long-drawn affair and remains contained to a certain level, people would move forward, move on, and then the markets would, stop. I won't say start ignoring it, but then factor it in and whatever limited impact it has on corporate earnings and so on and so forth. So we'll have to see how it evolves, but we at WhiteOak don't take any particular such call. We remain fully invested, and so are we today. There's a tail risk, obviously, with all these things, but market is capturing that probability at this time. But obviously, if it turns into event, then it would be a problem.
Prashant, in that case, you indicated there could be two outcomes, and the hope is that the outcome is on the positive side. But if it does continue the way it is right now, the way Russia-Ukraine war is happening, do you think before bouncing back, there could be a sharper cut? We were speaking to some market experts in the morning as well. They indicated there could be a 10 to 15% cut. Do you have any indication, or do you expect something like this to happen to Indian markets? And is India at a bigger risk versus the other emerging markets because of whatever is happening geopolitically?
I think it's impossible to say. Impossible at this stage to say, because first of all, we don't know what's going to happen in war, whether it intensifies, whether it gets worse before it gets better, and so on and so forth. Even if we knew precisely what's going to happen, then it still remains unclear what the market reaction would be to that. So to conjecture market would be down 10, 15, 20% or any percent, or to bounce back tomorrow, I think it is a lot of conjecturing and would not be on the basis of any sound analysis or insight, I would say.
Right.
But in terms of the comparison with other emerging markets, considering that we are a big importer of oil, gas, rupee right now is at a record low, between the EM's basket, do you think India is at a greater risk?
I don't think India is at a greater risk. Obviously, if you look at countries around the world, many of the countries are actually down a lot more than India is down for a variety of reasons. See, while a lot of our oil imports are dependent on the region, and if it gets completely blocked, how much of it can be substituted? See, oil is a global commodity. Just because we are in the proximity of the Middle East, it doesn't mean that we can't get oil from elsewhere. The cost of getting oil from elsewhere might be a few dollars more, a few percentages more. It's a global commodity, just like steel, aluminum. There's a global price. The global price will be higher if a certain amount of output is out of market for a while. But at that price, we should be able to procure it. So think of it as currently the oil price as it's showing is 83 and a half bucks. At 83 and a half bucks to somewhere between 83 and a half to say 5% higher, we should be able to procure as much oil as we want. I'm not an oil expert either, but that's what global commodities are. You add on the transportation charges and 5 to 10% higher from here, we should be able to procure the same Brent oil that is priced at 83 and a half right now.
Take that point on board, Mr. Khemka. The other question which we want to ask you is, it's now quite clear that countries across the globe will have to go ahead and ramp up defense spending quite significantly. Do you see an opportunity, number one, both for Indian exports, from Indian defense companies and within the Indian domestic space as well? Is that one particular sector where you see incremental flows go into?
See, I agree that for a minute, keep the stocks aside, but if you take the real world and the outlook for the defense companies, absolutely, I think the events of the last several years, I would say not just this war, but last 5 to 7 years, if you see the events, how they've played out, hate to say it, but bodes very well for defense companies. Everywhere around the world, defense spending is going to sustain, is going to, I think, rightly so, deserves to be ramped up and would stay at sustained high levels for a long time to come. Long time to come, certainly, I think, beyond a decade. Because, see, not just the wars that have happened, like in the Middle East, the Gaza war, and then the Russia-Ukraine war, but the whole thing where Trump has, de facto basically asked NATO, European nations to ramp up their contribution to NATO and ramp up their defense spending, and all the European nations have. They were for decades, falling back on the security provided by the US and had let their defense spending come way below what it ought to be given their neighborhood. And with the Trump administration asking them to jack that up, that is a huge source of global defense spending that's going to be there for many years, not just many years, for decades to come. And on top of that, what you've seen in other parts of the world, there is going to be a heightened level of insecurity and increased spending at every country's level, and percentage of GDP spent on defense ought to go up globally.
Okay. Prashant, quickly, if you can tell us before we let you go, had this war not happened, and considering that we did have a deal with the US on tariffs and earnings growth, which did come back somewhat in Q3, what is the earnings growth you were projecting, notwithstanding whatever's happening globally? And do you think the fundamentals domestically were strong enough to see a recovery going forward?
Certainly, as they say, the proverbial green shoots, the omnipresent green shoots were present in a lot of corporate commentary. Putting all this together, before this war started, we were expecting a recovery in earnings growth to low double digits for the year fiscal 27, which is not much higher than the nominal GDP growth rate, and which tends to be our default expectation for earnings growth from the Indian market, and particularly so given where corporate profitability is right now, which is neither suppressed nor hyper-normal, super-normal. So low double-digit earnings growth seemed fine, and even after the war, I don't think, at least as of now, there is a material change to that expectation.
All right. Thank you so much, Prashant, for joining in today with your thoughts on the markets and the outlook going forward. It's uncertain right now, but of course, this is what the market looks like right now. DLF is in focus because